Yeah. Uh,
So
the eighth one.
this one only, right?
Yes.
Eighth one. Okay.
Eighth one. Yeah.
Emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit of these trends? Emerging market companies do not have to worry about a lack of liquidity in their home equity market. Uh, which of the following has not been a benefit? Emerging market companies have found it easier to raise capital in the markets of developed countries.
So it is a benefit, right?
So it is a benefit, yeah. Emerging market companies have benefited from the stabilities of foreign exchange market. That is also
No.
a benefit only.
Okay. But markets are like markets can be or may not be stable, right? As in,
Emerging market companies have benefited.
yeah, like
Stability
emerging
of
means
foreign exchange
developed, right?
market is good, right? Then import export will happen better.
Okay.
First one, emerging market companies do not have to worry
So I think
about a
A.
lack of liquidity in their home equity. No, that statement is itself is not making sense.
Contradicting,
Yeah,
right?
yeah. A. Check then.
Yeah.
Check the answer.
Yeah.
Because that statement by itself,
Yeah. They are asking for
yeah.
like which is the wrong one.
Ah,
So yeah, A. Yeah, no,
yeah.
it's C. C. The trend in emerging markets have not led to the stability of foreign exchange markets.
See? Okay, wait,
Yeah,
let me
yeah. I
read.
think even I went for A, like when I did it, but it
The
was
trends
C.
in emerging market. Okay. The trends in emerging market have not led to the stability of. Huh? Acha, the statement is wrong. They are saying have not led to the stability of foreign exchange markets. The trends in emerging markets have not led to the stability of foreign exchange market. Okay. So that statement itself is wrong.
So it is not stable, right?
Yeah. Acha, so which has not been a benefit. Okay.
Hmm.
Okay,
That's
which
what
has
like.
not been a benefit of these trends. Not been a benefit as in the past. Okay. So emerging markets have benefited from this stability. This statement itself is wrong. No, foreign exchange market was not stable only, they are saying.
Okay.
So
So
that
like
means the
we'll assume
statement itself is
they're
wrong.
never stable, right?
Yeah. So
Even
that means
developed
this
markets.
statement, yeah, this statement itself did not happen. That's what it means.
Oh, okay.
So if statement did not happen, that means we did not get the benefit as well.
Okay.
Okay, then why? What is wrong with A then C?
Yeah.
Emerging
Like
market companies do not have to worry about a lack of liquidity in their home equity market. Emerging markets have benefited from recent trends in international markets. Which of the following has not been a benefit of these trends? Okay. Which of the following has not been a benefit of these trends? Emerging market companies do not have to worry about a lack of liquidity in their. So it is not a benefit. Okay, so it is a right statement. Then actually, yeah, all these two are right statement because it says it has not been a benefit. This statement itself is wrong. It's kind of unfair questions, I feel like. Okay, emerging market companies have benefited from this stability. So this statement itself is wrong.
okay.
Okay, that
So
is the
the
reason.
statement is wrong. Like is the C option like so the markets are stable or not? Like are they
No, it
benefiting
is
from it?
not. It is not stable. They
Okay.
have benefited from the stability. They are saying it is not stable only then.
Okay. So they have not benefited.
Yeah. So this kind of questions It's difficult. Like, so that means they themselves are saying like now the statement is wrong. But how do
Okay.
we know that if they are speaking,
Yeah,
then we will be believing
it's
them,
like they have made it up, and
Yeah,
how do we know then?
yeah, that is quite unfair. Yeah.
Yeah.
The
Okay.
trend in the emerging have not led, see, to the stability
Okay.
of foreign exchange markets.
So I think, like, is it there in the chapter, like in the theory? Maybe it's there in the reading. I'll go
It
through
will
it.
be there. It will be there. But then, how can we remember all those things? So we
Mm.
have to
Like
learn all
these are
this
like
by questions only. Yeah,
minute
yeah. We have to. Then
information.
you can cross check in curriculum,
Yeah, I'll just
and
check it
then,
once afterwards.
huh,
I'll mark this question.
so that, yeah, so that you tend to at least remember.
Yeah, I'll just mark the question. It's the eighth one. Okay. Okay. Yeah, 14th one.
Which are the following is incorrect about the risk of an equity security? The risk of an equity security is based on the uncertainty of its cash flows, based on the uncertainty of its future price. May- The risk of an equity security is measured using standard deviation of its dividends. Not dividends, C, right? Yeah,
Imagine standard deviation of its dividends. So,
yeah.
which is
C,
the
C.
wrong way to
Yeah,
measure?
yeah, yeah. Because dividend is a very too small amount.
Okay.
Okay, so we don't require standard deviation of dividends.
So 14th, I'll check the
Yeah,
answer.
this should be, this is
C,
fine
yes.
only. Yeah, this is fine.
C. They've said
Yeah.
some equity securities do not pay dividends, and therefore the standard deviation of dividends cannot be used to measure.
Mm-hmm.
Okay. But we do have like dividend discount models and all, right?
Yeah, but that is only for those companies which are paying dividend. That means only for matured companies. And
Okay.
also the dividend, see, why are you uh, investing? You are investing for two reasons. One is dividend and one is capital appreciation.
Capital appreciation.
Okay. So uh, deviations of, because the dividend amount itself is very small, the deviations, there is no, see, even if they don't pay also, it is not wrong. If companies are not paying dividend, they may pay, they may not pay. So there is
But then
nothing like
how
legally they are
how
wrong.
will even like compute deviation of dividends, right? Like
That you just have to take dividend. Like imagine every time they are paying 5 rupees, 4 rupees, 5 rupees, 6
okay,
rupees,
so
5
that is the
rupees.
standard deviation. Like
Now
it
you
would
have
be
to take the standard
every
deviation
year.
of all this.
Okay, 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 good, got it. Yes. 14th is done. The next one is, yeah, 17th one.
17th.
Yeah, which of the following is not a primary goal of raising equity capital? So like I listening to finance career.
Not a primary goal of raising equity capital. To ensure that the company continues as a going concern. This is the one. This should be the one.
C, right?
Yeah.
17.
Yeah.
Yeah, it's C. Capital is raised to ensure the company's existence only when it is required. Like going concern doesn't like it ceases to exist. It ceases to exist without like its partners. Like that is the meaning of going concern, right?
Going to ensure that the company continues as a going concern. Uh, the purpose of raising capital is not to continue. The purpose is to, you know, do business, right?
Yeah,
Business, how will you do? When you purchase long-term assets,
right.
when you generate revenue, you are
Okay.
not raising capital just to keep continuing, like, the just to prove that the company is alive.
in your life.
You
Okay.
want to create cash out of it. You want to do business out of it, right?
Business. 20th one.
Which of the following statement is least accurate in describing a company's market value? Which of the following statement is least accurate in describing a company's market value? Which of the following statement? Which of the following statement? Which of the following statement is least accurate in describing a company's market value? Which of the following statement is least accurate? Management decisions do not influence the company's market value. Increases in book value may not be reflected in the company's market value. Market value reflects the collective and differing expectations of investors. Should be least accurate. Acha, least accurate. Do not influence. Increase in may not be reflected in the company's market value. Market value reflects the collective and differing expectations of investors. So A.
Okay. Just check it. So it does affect. Increasing. Yeah, it's a.
Yeah.
So can you explain the other 2 points? Like,
Yeah. Increase in book value may not be reflected. That is not least accurate. That is accurate.
okay.
Increases in book value
But
may
so
not be
how
reflected.
can a book value increase? Right? Book value is the amount we had purchased an asset.
Increases in book value may not be reflected in the company's market value. Wait, let me see. The company's market value is affected by management's decision. Management decision can directly affect the company's book value, which can then affect its market value. What is that question number?
20, 20, 20.
Increases in book value may not be reflected in the company's market value. Market value reflects the collective. So this is the right statement. This is increasing book value may not be reflected. See, this is least accurate. They are asking. This is kind of increases in book value may not be reflected in the company's market value.
Increase.
Increases in book value which of the following statement is least accurate in describing a company's market value? Just 1 minute. Okay, 1 minute.
Okay.
Hello. Hello.
Yes, sir.
Which of the following statement is least accurate in describing a company's market value? Increases in book value may not be reflected. So, in the company's market value. A company's market value is affected by management decisions. Management decisions can directly affect the company's book value, which can then affect its market value. So management will decide how much equities to be raised, how much debt to be raised. Okay. So based on that, it affects the book value and then it affects the market value. So this is also right only actually. This is also when they're saying least accurate, it is also least accurate only. Now see now here also all these three are accurate only actually.
Okay.
But this one is management decisions do not influence. This is
It's the
clearly not
least one.
accurate. Yeah, least
Yeah.
accurate. Yeah. This one is accurate. One may not. No, this one also not accurate only. Company increases in book value may not be reflected. It will reflect, but what they mean is that management decisions only will impact first. They are the one who are deciding the book value. Book value means here it is referring to equities and bonds, like how much debt to be taken and how much equity to be issued.
Okay.
So they are deciding. Then it impacts book value. Then it impacts the market value.
Okay.
So
So book
between A
value
and
is
B,
not
huh?
like the price. Let's say book value is like book value is the price at which we buy a asset or like asset of a business, right? Let's say
Yeah, see,
we bought furnaces.
book value here refers to issue of equity and debt.
Okay.
So book value means issue of. So when you issue equity, then the book value will go up, right? It will be shown under liability balance sheet.
Okay.
Or when you issue debt,
Hmm.
it will show under liability,
Liability. So,
right? So it is affecting the book value, right? Book value of the balance sheet.
okay.
Yeah.
Hmm. And this is C is accurate, right? Market value reflects the collective and differing expectations of investors.
Yes. Yes. Yeah.
Like it is somewhat correct.
Collective and differing expectations of investors. Yeah, this is correct only
Okay. Yeah.
because it is reflecting both, right? Both are factored in.
21st one. So,
Okay. Okay. This say sums only total sales, net income, beginning of the year, total liabilities, number of shares outstanding, price per share. What is the question? Return on equity. See
yeah.
now when they say return on equity, sales, net income.
Yeah. So
Acha, I
in
think
the
this is
numerator,
not
there'll
done
be
for
net
you.
income, right?
Total liabilities, net income. Actually, this is not done for you, so you wouldn't
Okay.
know this. Return on equity, or we can do also. See this one.
Yeah,
Return is
let's
how
do it
much?
now.
Return is 2 million.
Yeah. That is the net income, right?
Net income. Equity is, yeah, we can do this. Is
Yeah.
number of shares and
Number of
uh,
shares outstanding is 1 million.
yeah,
And,
price
and
per
I think
share
we'll
and
have to
then
add or deduct all these assets and
equity.
liabilities, right?
Yeah, correct. Beginning total assets, beginning total liabilities. Okay, just hold on. Just 1 minute, okay.
Yes, no problem.
Total sales, net income, beginning of the year total assets, beginning of the year total liabilities. Hmm. No, we are not able to calculate this way. Equities we are not getting. So there is a formula, lengthy formula. It is called three-way DuPont analysis. Let's see if it works
Like we did it, right? Like
in
5 way
FS.
DuPont
Yeah, yeah.
FS.
Net profit margin into asset turnover
Net profit margin would be net
into
income upon
financial leverage ratio. Yeah, financial leverage ratio. So net
So I think
profit.
it's 80% because net profit would be net income by total sales, right?
Yeah.
So it's 80%.
Okay.
Then
Asset
asset turnover,
turnover sales by
sales by
average
total
assets.
average assets. So like 50 plus 35 by 2, right?
Sales is
Sales is 2.5 million pounds.
huh.
And to get the average of the assets, we'll add 50 plus 35 by 2, right?
Yeah. So sales is 2.5 million divided by
42.5
50.
million.
42.5. How?
So we'll have to take the average, right?
Yeah, but there is only one assets given here, right? We cannot
Okay.
take averages. So 50 million.
So 50,
So
I just do
it
50.
will be 2
It will
million.
be
No,
nine
this will
nine
be
percent, I think so.
sales is 2.5 divided by
Divided by,
average assets.
yeah, 5%.
Average asset is 50 million.
Yeah, 50.
How much?
5%.
Okay. So this is a ratio. So 0.05. Okay.
Yeah, okay. Then financial leverage ratio. So
That will be average assets by average equity.
average assets.
Average assets is
50 million, right?
average equity. Equity.
1 million.
So again, it is coming back to equity. Number of shares outstanding at the end of the year. Price per share at the end of the year. This becomes market capitalization, not equity.
Yeah, 20
Maybe
million, right?
yeah, but that will be market
Market
capitalization.
cap, yeah. Like, you wanted to get the average equities, right?
Equity, how do we get uh,
So I think
total
assets
assets?
minus liabilities. Would that give us equity? Because
Uh,
liabilities would include debts
yeah,
payable.
yeah, yeah, yeah. Correct, correct. Okay,
So
yeah, yeah.
50 minus is
Okay,
15, right?
actually, yeah. This also we don't have to do then. This simply assets minus total liabilities, 15
There's no
million.
total liability. Oh, acha, two, sorry. Yeah. So 15 million.
Yeah, into
So
100. Now you check.
2 million divided by 15 million into 100. Yeah, 13.33.
Yeah,
Oh, what did we
it
do
was
here?
very easy. This is all unnecessary time wastage.
Uh,
So equity, how to calculate it? Total assets minus total liabilities. Beginning. So it will give us opening equity.
Okay. And ROE is net income upon equities, right?
Yeah, net income upon equities.
Yeah, I just note it down.
Mhm.
Average equity, right? Average.
Net income by
What?
average equity.
Okay. Just a minute. Yeah, they have done the same thing at 15. Okay.
Mhm.
The 21, and then yeah, there are no more rounds in this video.
Mm.
The next one, just a minute. This is the fourth one.
Mm. Next
Fifth
one.
module. Yeah.
Next question.
Yes, sir. Just a minute. Next module. Yeah. Page 281. Euro has gone to almost 100 rupees.
Oh, euro has gone to 100 rupees.
Yeah. So it's
Mhm.
right now it's no, now it came down like it's 99.81.
For you, it will be all trouble, right?
Yeah,
Because you're going there to Europe.
like like few months back it was at
Mm.
93,
Mm.
94, and now it's 99.81.
Okay, it's almost 100.
Yeah. So it went like it was yesterday it was 100 point something.
Mm-hmm.
So
Oh, oh, okay. So it already touched 100.
yeah, yeah, it already touched in 100.8 something like that. Like
Mm-hmm.
almost more than like I don't know why is it happening because of those tariffs or what? Like
Um, every day, anyways, it keeps changing, correct?
mm,
Based on the demand of different currencies. Okay.
uh,
So now we don't have any specific reason.
okay.
Now it is just that every day based on demand and supply only. But in between, it must have got depreciated highly. Last few months, it must have got depreciated very highly.
Rupees, right?
Yeah, rupees.
Uh, the
Okay.
first one.
An
Uh,
alternative method of grouping companies by geography is least likely to be completed using location
I
of
I read this reading, then also I didn't
geography
get this one.
composition uh,
Uh,
primary listing of equity
I
is
read this
least
reading.
likely, na? Least likely.
Okay.
Grouping companies by geography. This is correct. So it is most likely.
So is it
Primary
C?
listing of head office. Wait. Least likely to be completed. Grouping companies. So, yes. Should
Primary
be
listing
C.
of
Yeah.
equity shares.
Acha, primary that too. Okay. Wait. Is least likely to be completed using primary. No, location of head office then it should be. Little dicey only, but I think A. Just
No, the
check.
answer is B.
Oh, because
Yeah.
it's least likely to be completed.
Yeah.
No, but
Like
this
they
is
have
most
given.
likely. This is most likely.
Hmm.
Least likely to be completed using geography composition.
Okay.
Wait. Alternative method of grouping companies by geography is most likely to be completed using geographic composition of revenue.
But they've
Then
said here is
this is
least
least
likely.
likely. Yeah. Because on the basis of where they are generating more revenue, they classify their business grouping.
Okay.
Okay, head office and equities. I have to check the answer. Wait. Where is it given?
It's the
Up only.
page number
Next.
no below. Yeah, 283, not up. Yeah. After the questions, they've given a very
Classification by
explanation.
country is typically by the country where the issuer is incorporated, the country of the primary listing of its equities, the location of its headquarters are or market perception. Note that classification by geographic composition of revenue is generally not the approach taken, though this aspect may be foremost concern for an analyst. Classification by country is typically by the country where the issuer is incorporated, the country of the primary listing of its equity securities. It's a strange classification because I have
Even
seen.
after reading the chapter, I didn't get it. I was finding these like classification, and I didn't get it. Like even after
Okay,
reading it.
if I see here, many times, like if I say they classify based on products, say revenue. These are all products: lab
And not
grown
on
diamonds,
geographical
natural.
basis, is it?
Uh, they do geographical basis.
But
See here,
that is least
USA,
okay.
USA, SIPS, Mumbai, Goldium Jewelry subsidiaries. You can see North America.
So these are country classification by country strictly by the country with the issue.
Mm,
Here, the thing note that classification by the geographic composition of revenue is generally not the approach taken, though this aspect may be the foremost concern for an analyst. So,
mm.
like, what are they trying to say? I didn't even get it.
See, an alternative method of grouping a company by geography. Grouping a company by geography means typically, see here, they will say like we are doing 80%, 70% business from US, UK.
Hmm.
So based on the revenue that they are getting, they try to classify that we are doing so much of business there. But I think that's not what they are conveying. See here, 88 percentage into or USA, Goldium USA, SIPS Mumbai. But then here they are speaking about location of head office and primary listing. The alternative method of grouping companies is least likely to be completed using alternative method of grouping companies. Okay, 281, right? Okay, let's quickly check if we can get this. Here it is. See, see here, they are classifying by geography. Other approaches, grouping may be less. Okay, other approaches that are used in context such as index constructions and investment. Okay. Index construction and investment performance evolution include the following. Geography, in which companies are classified by country, and then countries are aggregated into categories such as developed, emerging. Classified by geography, in which countries are classified by country, and then developed, okay, emerging. Classification by country is typically the country where the issuer is incorporated, the country of the primary listing. Example, Toyota is universally classified as Japanese company. However, its largest market share by revenue is okay. Acha, understood. Like Infosys is an Indian company, but its revenue comes from US. But it is still classified as an Indian company because it is listed here in India. Okay, that's what they
So
mean.
like most of Infosys business comes from US.
US, but still it
Okay.
is classified as an Indian company only because reason being it is listed here.
Yeah.
Okay, that's what they mean. Okay.
Okay. So
So an alternative method of grouping company because it is listed over here. That means primary listing or
okay.
its head office is over here. So we call that as that company,
And
Indian company.
geographic composition of revenue is where it is making most of
Huh.
its
Yeah,
profit,
yeah.
like
But
most
we
of the
don't,
earnings.
yeah, we don't identify it, as if like it
Okay.
is from that
Okay.
country. We
Okay.
always say
Got it
it's
now.
an Indian company, right?
Company. Even though my
Mm.
business is like running
Yeah,
overseas.
correct. Reason being, its head office is over here or it is listed here.
Hmm.
Okay. The next one.
Yeah. Third one.
Lower industry concentration is usually associated with a high degree of competitive intensity unless the industry is most likely global service oriented, one with low product differentiation. Lower industry concentration is usually associated with a high degree of competitive intensity unless the industry is most likely uh, lower industry concentration is usually associated with high degree of competitive the high degree of competitive intensity unless the industry is one with low product differentiation. Uh-huh. No, lower industry concentration is usually associated with a high degree of competitive intensity because it is concentration, lower industry concentration associated with high degree of competitive intensity unless the industry is most likely global, unless the industry is most likely global service oriented, uh, one with low product differentiation. Lower industry concentration, lower industry concentration means
Like
fragmented industry, right?
fragment.
Lower industry fragmented is usually associated with high degree of competitive intensity. Okay, unless the industry is most likely, acha, then it should be most likely global because if it is global, like yeah, like Unilever or
Like,
such kind of
can you give
company,
an example of this fragmented one?
like
Like high degree
FMCG
of.
companies, you take masala and all that
Hmm.
stuff. So it is there are so many varieties, competitors are there, right?
Right. Yeah.
So high degree of competition is there. Unless the industry, but still in that one, Unilever stands out. Hindustan Unilever.
Right.
It should be A. Just check.
Yeah. It's B, sir. Service oriented.
Unless the industry is most likely service oriented. This is quite tough. I have to then check this as well. High degree of competitive intensity. global nature are useful for some sectors and industries that are in fact global, but they can be less useful for more service oriented companies that compete nationally or even locally because of customer behavior or regulations. Low industry concentration. Low in lower industry concentration is usually associated with a high degree of competitive intensity, unless the industry is most likely service oriented. Okay. Low industry concentration is usually associated with a high degree of competitive intensity, unless the industry is most likely service oriented. It's very unconvincing the way this English is used. Lower industry concentration is Lower industry concentration means fragmented. Fragmented is usually associated with high degree of competitive intensity.
So,
Fine,
what do we mean by
unless
fragmented? As in, they're not uh, like
unless the
disposed
industry.
one, right?
Hmm, hmm.
Like disposed one, as in there are
Con-
many. Let's say we can say,
fragmented, like there are
uh,
many branded also as well as unbranded products are there.
like these
Unbranded
optics,
brands are
optics
there.
people,
Huh?
optical, those who make like lenses,
Huh,
glasses, and all.
huh, huh. Many branded as well as unbranded companies are there. So unless the industry is most likely service oriented. Okay, fine. It's more than technical thing, the way they are writing English, that is very
Yeah,
painful.
like these are high level English.
Very
Like
confusing English
it
they
is like
use.
the testing of verbal ability
Verbal, yeah,
sometimes, I
and it
feel.
doesn't look like finance. It looks more
Yeah,
like English exam.
true.
Anyways, like service oriented. So if it is service oriented,
Hmm.
then only uh, lower industry concentration is usually associated with high degree of competitive. So that means fragmented industry will have high degree of competition unless it is service oriented. That is the meaning.
Okay,
The
so
meaning
in
is
service oriented, there's not much competition, is it?
no. There also competition is there. See,
Hmm.
they are saying the work that you are doing, everybody can do. So
Okay,
how will you stand out? Only by giving additional services.
okay. Hmm.
So that's what it means. So it's a fragmented one. That means everybody is doing. So there is high degree of competition.
Yeah,
Then how will you stand out? It's most likely by service. That means more and more you are giving service. That is the only way.
okay. It's only possible in service oriented. And the point C says one with low product differentiation.
No, then you cannot stand out only. No,
Or what if it was had been the high product differentiation?
that means you are creating really a different product. Then you don't care
Okay.
about the competition.
So then that would be the answer, right? If let's say there was no service oriented point, and
Then high product differentiation would be the answer. So
okay,
either you make different product or you give more services.
right. Let's go to the next one. Next reading. 7. Yeah, and so we are left with this one. Like I didn't do any of the questions. Like there are seven in total. It's a
Page
big
number.
one.
Page
Page
number.
number 242. Yeah, I think this is the fifth module. Yeah,
242.
yeah, 242. It's the fifth module. Because there are degree of financial leverage and this there's something DOH degree of
Yeah, yeah, yes. We didn't do, is it?
like this is a big question, right? There are many clubbed in together. There are seven
Case
questions.
study. Okay.
Yeah, it's a case study like question. So I think we won't get such
No, you will
questions,
not
right?
get case study. No, no, no. It's just for
Yeah.
practice.
And there are I think we didn't do all this. What is DOH and DSO?
We didn't do. Okay, then we will do it then next time. Okay, this one
Yeah,
then.
yeah. But
No,
what is DSO? Like DSO and DOH, what are these?
no, this is days of sales outstanding. That
Okay,
means
days of sales.
days of account receivable turnover ratio. This is days of uh, this is inventory.
Okay,
Inventory. The
days of
long form.
inventory.
No, the long form is uh, this is days of payable outstanding.
DPO.
Days of inventory on hand. Days of inventory on hand.
Okay. Okay, so we did this, right? Like
Yeah,
inventory, all these
yeah,
ratios.
yeah, yeah.
But this is like this is like
This
a
is
case
days of
where
inventory on hand. This is days of sales outstanding. That is account receivable. This is
okay.
accounts payable. Days of accounts payable turnover ratio.
So we'll do it later, like
Huh.
but like should we do it like will we won't have such questions, right? Like
No, but you practice it. You have time now, right?
yeah.
No, if I have not done, then I will do it next time. All this. If I have done, degree of financial leverage and degree of operating
Yeah, yeah,
leverage
we did
ratio.
the formulas and all, but
We have done, right? Then
yeah.
okay. Did I do all this one activity ratios like degree of? I think yeah. This also I have done.
Yeah, like in
Accounts
FS
receivable
also
turnover
we did.
ratio I have done,
In
right?
FS also we yeah we did all this.
No, here online did I do days of payable ratio? Okay. Anyways, if you know this, then you do it. Okay.
Okay, I'll
But
try
try.
to.
Don't leave it. If you face
Okay,
problem, you let me know. We
okay,
will then do it again.
okay. So, yeah, page number 332. Seventh module, question number 4. 332.
Hmm. 334, 33.
Yeah,
Hmm.
332.
Hmm.
Fourth one.
Okay. An analyst forecast is a company's sales using historical results approach and top-down drivers. An analyst forecast is a company's sales using historical results approach and top-down drivers. An analyst forecast is a company's sales. An analyst forecast is a company's sales. Forecast is a company's sales. An analyst forecast is a company's sales using historical results approach and top-down drivers. Expected industry sales and expected market share. The analyst observes that the forecast is within the range of management guidance on sales, but is towards the upper end and not closer to the midpoint. Which of the following is the most likely explanation for this observation? The analyst has been overly optimistic in estimating the company's expected market share. Management's true expectation are towards the upper end, but management has created a range using a pessimistic lower end that is more easily cleared. The midpoint represents managers' true expectations and management as a lower and better estimate of market growth based on macroeconomic variables. Okay. An analyst forecast is a company sales using historical results approach and top-down drivers. The analyst observes that the expected forecast is within the range of management guidance on sales, but it is towards the upper end and not closer to the midpoint. But is towards the upper end.
The top-down driver is like from
Okay,
first
it is
selecting
towards
the
the
sector.
upper end. So that means, let's say the growth they mentioned 10 to 12 percentage.
Okay. So he thinks that the manager, that the management has like
Huh.
overestimated the growth rate. Like, is it-
So 10 to, let's say 10 to 13 percentage.
yeah,
And
management says
this
13%.
is, and analyst says 13 percentage. Okay.
The focus is within the range of
So that means,
but then the analyst is saying that the management is toward the upper end and not closer to the midpoint, right?
huh.
So 13% would be the management's this thing, right?
No, this is the upper
Expectation.
end. No, this is the upper end. And the analyst's forecast is also 13 percentage only. So the upper end.
Okay.
So that means he has said that either he will reach here or he will be little down to be on the precautionarily. He has mentioned 10, 10, 11 also, 10 to 13. So that if he doesn't reach, so this is the actual one, that is his ability. If he doesn't reach also, so to be on the safer side, even if it reaches to 11, 12 also, he's still within the range. Okay,
Okay.
so this is how even we speak, right? Say for example, you want to conservatively say how much marks you will score conservatively. So how will you
Right.
say? You don't want to go wrong. Then what do
Yeah.
you say?
So say
Let's say
70 to 80%, let's
70
say.
to 80%. You are, that means maximum you are going to score only 80.
Yeah.
70 is so that even if you get 75, you will say like, yeah, that's what I said, 70 to 80.
Right.
Okay. Similarly, now here, the analyst has been overly optimistic in estimating. No, management's true expectation are towards the upper end. Correct. The management has created a range using pessimistic lower end. Correct. This one should be the one B. Just check this one.
B. That is, yeah, it's B.
B. Yeah, because this is how we speak, right?
Yeah.
You understood or not? This is how we all speak.
Like I didn't get the management's thing. Like what is management expecting and the analyst?
So management will always come up with their expectation, like by how much the company can grow.
Hmm.
So they said the company will grow by 10 to 12 percentage,
Okay.
and the analyst is calculating in his own way. Management said 10 to 13 percentage. Now the analyst is saying 13 percentage.
Okay.
So that means the management said the truth, but with conservatively. They said 10 to
Hmm.
13 because they will have some pessimistic view also, like what if they don't reach to 13 percentage. See, they don't want to open their mouth and speak something which later on found to be untrue. So they will
Okay.
always say what they can reach, very high probability to reach, and
Okay.
worst case.
So analyst has bet on the like upper end. Like he's
Yeah,
on the
yeah,
upper
yeah,
end.
yeah.
Got it. Yeah. So, so the fifth one, like I got it. I'm not sure if I what I understood is correct. Like the fifth one is
A clothing company which initially produced designer clothing. has increasingly entered into the mass market. Okay. Which of the following approach to forecasting revenue is least appropriate? Historical results, analyst discretionary forecast, historical base rates and convergence.
So why like A is the answer, like historical results. So why my understanding was that since they're new into it, right? As in, so they
Base rate.
can't basically base the historical results.
Yeah, historically they must have sold less only, right? With high
Yeah,
margin.
yeah, and now they are
Now they will
they
sell
are in the
more with
phase of
low margin.
economies of scale, maybe like
Yes, yes.
something like that.
Yeah. Most appropriate is analyst discretionary, correct. Historical base rate and convergence.
Yeah, so can you
This will
explain
not
B
come
and
least
C?
appropriate.
Can you
Okay.
explain B and C? Yeah, point B and
See, which of the following approach to forecasting revenue is least appropriate?
yeah.
This is most appropriate actually. Analyst discretionary because you have to find out on your own what will be the new sales now. You cannot rely on historical results.
Sorry. Hello.
Yeah, you cannot rely on historical results.
Yeah, I got
Okay,
it.
analyst is discretionary forecast. Discretionary means on your own you are deciding. Discretion,
Okay.
your way, your style way you are deciding what should be the new sales now because there is no other historical data to predict.
Right.
Okay. Third one is historical base rates. Now you can say from where they are now, how much they will grow, but you cannot say that because they were growing at 5% before, now also they will grow at 5%. Now finally they have reached. This is they have reached to 100 sales. From 100, how much it will grow? That is your discretion. But at what rate they grew and reached to 100? That is historical rates. That may not be followed in future.
Yeah. So since now they may entering, a new market, so
Yeah.
like
So the growth rate all will change now.
yeah, the
But
absolute
everything
number
will
may
be
be high,
from
but
here.
the
From
percentage
here,
would
it
be
will
less.
change at a very high rate.
Yeah.
From 100 only, it will change at a very high rate.
Okay.
Hmm.
Seventh and eighth last two.
Yeah. An analyst notes that a company's capital expenditure do not follow a discernible pattern. Uh, company's capital expenditure do not follow a discernible pattern. The company seems to have periods of very low capital expenditure. Okay. And periods of high capital expenditure. Okay. Management does not provide any guidance on capital expenditure. Fine. Hmm. Hmm. Okay. Management does not provide any guidance on capital expenditure. The analyst should develop a forecast of capital expenditure based on company's usage of PPE, industry average, and company's average capital expenditure. Industry average will not come. See, analyst notes that a
What is
company's capital
discernible
expenditure
discernible pattern?
it is not predictable. Discernible pattern means not a predictable one because sometimes it is very low capital expenditure, sometimes very high capital expenditure,
Right.
and the management is not providing any guidance.
Right.
So it should be based on in not industry. It should be company's average capital expenditure or company's usage of
Yeah.
PPE.
Like between these two. Like,
Yeah, yeah. So company's usage of PPE and company's average capital expenditure.
so I think
Yeah, go for
usage
average. No, average.
average.
Average, I
Okay, yeah,
think.
because
Just check.
usage would differ. Like
Yeah, it will differ time to time.
okay,
So
seventh.
average should be the
No,
one.
but it's A based on the company's spending
Capacity.
pattern.
capacity. Okay.
Uh,
Seventh. Okay, let me see the answer. Company based on the company spending pattern. Okay, it most likely makes a capital expenditure based on capacity needs as it grows. If it is approaching full usage of existing capacity, it will expand. So based on the company's spending pattern, it most likely makes capital expenditure based on capacity needs as it grows. Okay, so not average but based on spending.
like what is like what are they saying in the explanation?
Based on the company's spending pattern. So the analyst should develop your forecast. So if there is like high capital expenditure happening, forecast highly. Low capital expenditure happening, forecast less. Suddenly, see they are going for high and then it is going for low, then it is going for high. So when it is going for high, you also think that it will go high. Then when it is going for low, go in that trend only.
Okay.
Okay. So depending upon how it is being used,
Right.
company's usage. Hmm.
The next one. So this is the last one in this reading. Thank you.
Okay. An analyst predicts that if a company's technological developments are a success, the company's operating cost will be reduced by 15%. An analyst predicts that if a company's technological developments are a success, an analyst predicts that if a company's technological developments are a success, if a company predicts that if a company's technological development, an analyst predicts that if a company's technological developments are a success, an analyst predicts that if a company's technological development are a success, the company's operating cost will be reduced by 15%. Okay. As a result of the reduction in cost, the company will reduce the average selling price of its products by 5%, and the volume of sales will increase by 8%. The company's current gross profit margin is 40%. If technological developments occur, the company's gross profit margin will be closest to. Okay. This is a good question. Calculations.
So I think we can take a number, right? Let's say for the
Yeah.
year for
Yeah.
the first previous like the current
Yeah.
year to the let's take the sales as 100 and then we'll
Sales
get it
100. So cost of goods sold will be
sales 100
margin, gross profit margin is 40 percentage. So cost of goods sold is 60. Now they said company's operating cost will be reduced. As a result, the reduction in cost, the company will reduce the average selling price of its products by 5 percentage. So it will be reduced by 5 percentage. So into 1 minus 5 percentage. Cost of goods sold, selling price, right? And the volume will increase by 8 percentage. Acha, volume they said, volume, na? So volume will become, initially it was 1, now they will sell 1.08.
so 108, right?
So again, it will be 108, yeah,
108,
108
and we can't like take
cost.
so we'll take one like we'll
100 into
for the COGS
COGS, 60 into 1 minus 5 percentage calculate, because the cost will go down by 5 percentage.
16 to 1 minus 5 percentage.
Huh.
Okay, just a minute. Minus 5 percentage 0.95 into 60. It's 57. Yeah,
57.
yeah.
108 minus 57.
Just a minute. 0.08. Yeah, it's 51.
So now they are asking gross profit margin. So gross profit is 51 out of 108 into 100.
51 108 into 100. 47.22%. But is it 47.2?
The company's gross profit margin.
The
Sales
answer
will
is B.
increase by 846.3.
Yeah.
Okay. The
Five.
reduction in cost, the company will reduce the average selling price by 5%. Average, no, 1 minute. The company is also reducing by 5% average selling price, not the cost of goods sold.
Yeah.
This is wrong.
It's sales, right? Like,
This is wrong. Okay, let's do this again. Sales amount is 100. Cost of goods sold is 40. 40, not 40, 60. Gross profit margin. Uh, so it says selling price of its product is coming down by 5%. So instead of 100, now it will be 95. And instead of selling 1, you will be selling 1.08. Now you calculate.
okay. 95 into 1.08. 102.6.
102.6. Now
What is it? 9.
cost of goods sold is 60. So
Cost of
this is 60%. Take 60% of 102.6.
61.56.
Take this difference.
Yes, you just right. 102.6. It's 41.04.
I think I'm not doing properly. Let me check only. Acha, this is right only. This step is right. Cost of sales. Huh. Yeah. Cost of sales is wrong. Cost of sales is 60 into. How come it has come to 15 percentage? 15 percentage. They reduced.
Current gross profit margin is
Company's operating cost will be reducing. It says operating cost. It is not saying cost of goods sold. The company's operating cost will be reduced by 15 percentage. It's not operating cost. No. Anyways, so this is reducing by 15 percentage. So just calculate this 60 into 1 minus 15 percentage
1 minus 15 percentage into 60, 51.
into 1.08.
55.08.
Now take this difference.
Plus 102.6. 47.54.
So 47.52 divided by 102.6 into 100. Calculate this.
Yeah, now it's 46.315. Yeah, right.
But again, see here they are saying operating cost. Why will I reduce? Feel quite unfair.
Cost of goods sold. So COGS includes all those operating costs and all, right? Uh,
Mm.
all those administrative expenses and all.
Yeah, all those will come here, right? Sales and general administration. Okay, it
Okay,
says
yeah.
operating cost. Okay. Okay.
So like, is it wrong? Like the way they have
No,
done
no,
it?
no, no. They mean this month. They mean operating cost as in cost of goods sold. What I was thinking is SG&A, but okay, it's cost of goods sold.
I'll just go through the question one time again later.
Hmm. Hmm.
I'll read it.
Yeah.
So I think this one is done. Given. The last one is
Equity valuations, right? Okay, these all are sums only. These all will be much better and easier. This we will do
okay.
next time when even Shravani would be present. Na? That time we will do.
Yeah, 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 okay.
Okay,
No problem. So,
so we'll
no,
stop.
there are also like this thing. There are also
Theory,
theories. Yeah, but
uh,
we'll do it later. No problem. Yeah. There are also
theory. Which one question?
no, so like she's not there, no, so she'll also miss like a lot then. Let it be. We'll do it on the
Okay,
next class.
okay, then we'll do it next time then. Okay,
Yeah, because there are many questions in here. Like in total there are 36. So like even
hmm.
I have many doubts. So let's do it in the next class. Okay.
Okay, then fine. Okay, okay, we'll stop now.
And so like for the like we are done with portfolio management, right?
Yeah, yeah.
All the